Welcome to Business Matters. Today, our topic is the stock market. We'll be looking at the intricate content information relating to the stock market. Our lesson objectives. To guide our discussion, we'll be looking at a definition for stock market. We will also seek to explain the stock market as a form of investment. And thirdly, we'll seek to explain the difference between a trader and an investor in this stock market. Let's proceed. Now, we want to look firstly at the forms of investments. Now, different income and investments are like, for example, the stock market, government and government securities. These are two main areas where deferred income and investment is placed. Well, let's talk about government securities. Government securities in the form of bonds. And a bond is a fixed income instrument that represents a loan made by an investor to a borrower. All right? So you are lending your monies to a business or an entity, and at a later date to pay them back with interest. Debenture is also an government instrument. A debenture, yes, is a long-term security. It's a long-term security or loan yielding a fixed rate of interest. And it is issued by a company, right, and secured against asset. So we have what is referred to as secured debentures. Again, it's a form of investment. You're lending to a company or you're lending to an institution, and the institution will pay you back the money with interest after a number of years. Our third item is referred to as mutual funds. Now, mutual fund is a professionally managed investment fund that pools money from many investors, right? It pools funds from many investors to purchase securities. Let's move on to looking at the matter of the stock market now. So we're going to give attention to the matter in relation to the stock market. Now, the stock market, or the stock exchange as it is referred to, is a market in which shares of company stocks are bought and sold. So it's a marketplace for the movement, buying and selling of shares in companies. Now, companies have the desire to grow and expand, so they will participate in the stock market because of the intention that they want their institution to grow or to expand. The companies who participate in the stock exchange also have a desire to raise capital to purchase assets. So they might need additional monies to purchase some important capital assets to put into the company to improve their production. They'll also enter into the stock market as a result with the intention to buy new products to expand. So these are basically reasons why companies participate or become a part of the stock market. What are some of those benefits that they can accrue by allowing their companies' share capital or their stock to be a part of the stock market? Right, so we say that The companies may desire to grow and expand. They may desire to raise capital to purchase assets, or they may desire to buy new products, right, to expand. On the other hand, investors desire to find companies where they can invest their funds, right? So this is from the standpoint of the investor. They are seeking somewhere that they can invest their funds. Two, to protect their money from inflation and taxes. So that's the second reason why investors want to go into the stock market. Thirdly, the investors want to earn dividends. Yes, a dividend income from company profits. Fourthly, contribute to the development of their favored company. In other words, the person want to be a part of the development of their favorite company, and they want to contribute to its expansion, improvement. All right. Market securities. We're going to now look at market securities. Now, the stock exchange operates in two levels. One, as a private market, right? A primary market, beg your pardon, a primary market. Now, as a primary market, the stock exchange links with investment banks and businesses seeking to raise capital by selling shares. So what we're saying here is that the stock exchange operates in two levels, and one is as a primary market. Primary market for who? For investment banks and businesses. In other words, the investment banks that are existing, they may have funds and consistently have funds, yes, because their customers may have put money in their banks, and they need to find places or location where they can invest these funds and bring a return to their customers or their investors in their banks. So as a primary market, yes, the stock exchange links investment banks and businesses seeking to raise capital, yes, by selling shares, right? Secondly, as a secondary market, the stock exchange provides a means for individuals desiring to purchase shares in companies, right? So you and I, we want to become a part of a company. We want to invest some money. So we're at the secondary level of the market where we're buying shares into the company. All right. Now the stock exchange put those wanting to sell shares in touch with those seeking to buy shares, right? So that is what the stock exchange does. It is bringing sellers and buyers together. Those who want to sell their shares, right? And those who are seeking to buy shares. The market, and that is where we refer to as the market for second-hand shares, right? So the market for second-hand shares, where shares can trade hands, can move from hands. Yes, one person buys and decides to sell his share, another person comes in and buys from that individual. So it is referred to, the market is referred to as the second-hand shares, right? The market for second-hand shares. Now, players in the stock market. Let's look at the players. Who are those players in the stock market? One, buyers, sellers, dealers, brokers, and market makers. These are the players and persons who frequently operate within the stock market. Now let's look at the stockbroker, right? And the stockbroker is an agent or firm that charges a fee or commission for executing, by buying and selling orders for an investor. So the stockbroker is really the agent that is seeking to be what I'll refer to as the middle person between the individual who needs to buy some shares and the individual who is selling the shares. All right. So a stockbroker is an agent or a firm that charges a fee or commission for executing the buying or selling of orders for an investor. Now, they are intermediaries, as I indicated, who have the authorization and expertise to buy securities on an investor's behalf. So, for example, let's say I want to obtain some shares in Grace Kennedy Company. I go to a stockbroker, maybe one of those investment houses, yes, may operate as a stockbroker, right? And I am now going to be expressing to them my desire to buy the shares in Grace Kennedy, and they will be the ones to find those shares at the price that I want and buy it for me, right? And then the whole process of registration of me being a shareholder in Grace Kennedy. So the stockbroker is really the person, the intermediary that is seeking to buy the shares on behalf or selling the shares on behalf of the investor. All right, so we're moving on in the process. The market makers. Now, market makers are typically large banks or financial institutions. They help to ensure there's enough liquidity in the market, right? So, market makers are typically large banks or financial institutions who have the capacity to buy up a lot of shares or to sell or place a lot of shares on the market to keep the stock exchange liquid. They help to ensure there's enough liquidity in the market. That means that there is movement of stock, that the movement of stock is taking place on the stock exchange, that activity is taking place on the stock exchange so that it becomes attractive, right? So that people want to become a part of it. All right, those are referred to them as market makers. Now, a firm that is prepared to buy and sell a particular stock on a regular basis. So I'm going on further to say that a market maker is really like a firm who is prepared to buy and sell a particular stock on a regular basis. Now, a stock jobber is an informal term for the market maker. So you might find in some texts or in some places here they talk about stock jobber. A stock jobber is simply the informal concept or term given to a market maker. And remember now, the market maker, they are specialists in the stock market. Now let's look at the role and functions of the stock exchange. 1, the stock exchange assists industries to raise capital. So companies that wants to raise capital, they can put their company on the public stock exchange, and then upon doing so, they are now eligible to obtain or to raise capital. So they put out their shares, and Their stocks are out there rather for sale, and then people will go in and buy. And once they buy these shares, the company is obtaining additional capital. So that means that they provide the stock exchange provide a well-organized and safe market for investors to trade in second-hand securities. Second function here is that the stock market allows the securities to be bought and sold. It is the shareholders that profit from the trading of shares. It is the shareholders that profit from the trading of shares, right? So it's not the company that is going to profit from the movement of the shares so much as it is, especially when you refer to the second-hand market, right? It is really the shareholders. The shares are changing hands, so it's moving from one individual to another. So one person was a shareholder, he sells his share, and then somebody else becomes a shareholder. If you sell the share at a profit, at a premium, or at a profit, then you are benefiting from the trade. Second function, that is that it protects shareholders, right? As only reputable companies are listed. So the shareholders don't have to worry that they are investing in companies that tomorrow morning is going to be closed down, or they are not genuinely operating as real companies, right? The principles and the policies that exist and the laws that exist require certain obligations from companies that are going to be listed on the stock exchange. Now, fourthly, another function of the stock market is that stock exchange is that it provides market facilities for the government. It provides market facilities for the government. What do we mean by that? The government is able to use the market to issue securities. So the government can use this medium, the stock exchange, as a medium, or this market as a medium to issue securities that they have. The fifth function here is that the stock exchange improve the moral standards of businesses. The stock market has as a code of conduct to regulate the companies. So this is another important function of the stock exchange. It improves moral standards of companies. So they have to play fair. Their documents have to be up to date. Their declarations, their financial statements, their full disclosure as to their operation. And so the moral standard of the company is at a high, and because of the requirements to participate in the stock exchange. And therefore now, because these companies are closely regulated by a code of conduct, right? It keeps the market safe and with good integrity. Now, stock market speculators and traders. And we're going to move into that now. There are 4 types of speculators. 1, bulls. 2, bear. 3, stags. And 4, lame duck. These are 4 types of stock market speculators: bulls, bear, stags, and lame duck. Now, speculators are those who purchase shares with the hope of making a profit, or any entity or individual that attempts to make opportunistic profits from changes in the prices of financial instruments over a short period of time. So what they're saying here is that the speculators, yes, they're going into the market, and there may be individuals who are seeking to use the market to make profit. All right, they're opportunists, right, and attempts to make opportunistic profits from changes in the prices of the financial instrument or in the prices of shares. So they may go in and start selling shares. Yes, going and start selling shares at a particular price in order to encourage a certain kind of demand. Or they may go in and start to buy shares with an intention to share for the share price to change. All right, so let's look at the first type of speculator, a bull. Now, a bull is a type of speculator who anticipates a rise in the price of securities. So this person now is getting into the market with the hope that the price of the shares will rise so that they can be able to profit from the sale of their shares. Now, this type of speculator buys financial securities so that he can sell them in the future at a higher price. So this speculator, the bull now would going trying to get this, buy up a number of shares at low prices, and then goes back into the market, yes, with the intention that the prices intend for the price to go up, and when the price goes up, then they start start selling in order to rake big profits. Now, when the price of securities increases, the speculator gains a profit. Now, bullish speculators buy when the market is trending upward. Again, a bullish speculator buys when the market is trending upward, or if he expects the price to start rising. A bear speculator is a speculator who anticipates a fall in the price of securities. This type of speculators goes short. By going short, the speculator borrows securities in order to sell them to an available buyer with the intent of buying them back at a lower price. So the bear is simply working the market to get the stocks at a lower price. Then the stag is a type of speculator that applies for new shares of a company with the view of selling them at a premium after allotment. So they apply for the share. The stags here now is really seeking to get a number of shares, and then upon getting that number of shares, sell it back quickly for profit, right? So the stag is a type of speculator that applies for new shares of a company with the view of selling them at a premium after allotment. A stag type of speculator is regarded to be more risk averse than bears and bulls. The word stag refers to a day trader who attempts to gain profits from short-term price movements of securities. And then now, the last type of speculator is referred to as the lame duck. Lame duck is a speculator who is in or near bankruptcy due to bad trades, right? Person who have entered the market and they are not being successful at all. They are losing. A lame duck is a type of speculator that suffers multiple losses due to his or her incompetencies. All right, let's move on now to the difference between a trader and an investor. Now, investors are corporations corporations are individuals wishing to invest an amount of money, keeping it in the market for a long time to gain profit. So an investor here is putting in monies into the business and are buying up stocks, yes, of a business, and they're holding it for a period of time, yes, with the intention that over a long period of time the stock price will go up, and so they will gain a profit on the stock they are holding. They usually have large amounts of available funds to afford leaving their money on the market for years, right? So the investors do have excess cash that they can allow to be used to buy these stocks and these securities and to hold them for long periods of time without any great demand. Now the traders are in the market to make quick profit. That's a big difference. Investors are in there, and they're in there to buy, hold, and then to make a profit. Traders are now in the business of entering into the market to make a big profit, or to make quick profit rather. Now they prefer stocks that are volatile. So traders prefer stocks that are volatile. That means it fluctuates. The price will go up and can go down, go up and down, right? To benefit from the changes in prices. Now we talk about volatility. Volatility refers to the price fluctuations. That is how fast and often the price change. Thank you very much for sharing with us. This was our lesson on the stock market. I hope that the lesson has been helpful to you. Please like and share this video. And of course, if the content is meaningful, we ask that you click that subscribe button, and you'll be seeing when we shall upload a new lesson. Thanks again.